Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market Update and Analysis, May 19th, 2026. This video presents a direct informational narration of the source document. All right, let's jump right into the data.
Here's a quick look at our roadmap for today. We'll be covering geopolitics and yields, crypto and tech deleveraging, implied correlation, the VIX settlement, and finally, some major AI corporate actions. Let's get started.
So today is Tuesday, May 19th. Now, despite the U.S. Vice President coming out this afternoon and stating that progress has actually been made in negotiations between the U.S. and Iran, and emphasizing that neither side really wants to resume military action, the market, well, it remains highly skeptical. Major U.S. stock indices close collectively lower today, as investors are basically just waiting for real clarity on the Middle East, all while sweating over the trajectory of Treasury yields. We're seeing capital clearly shift into defensive sectors, things like energy and healthcare, as a risk aversion play. But the really massive number today, the 30-year Treasury yield spiked to an intraday high of 5.198%. That's literally the highest level we've seen since 2007. We are watching this intense negative feedback loop between geopolitics and monetary policy, and together they're just pushing up the market's overall risk premium.
Adding a bit more fuel to the fire, Donald Trump stated today that if an agreement can't be reached, the U.S. might actually launch strikes on Iran again in the coming days, specifically looking at this weekend or early next week. He acknowledged that the inflation spike we're seeing, driven by this geopolitical conflict, highly complicates the prospects for rate cuts. He noted that core data just can't be properly assessed before the war ends. Furthermore, he conceded that while the newly appointed Federal Reserve Chair, who he nominated, shares his inclination for accommodative policy, reality just dictates a compromise with the oil price shock. Further efforts to promote rate cuts may simply need to wait until the war with Iran concludes. This is a big deal. It signals a real softening in his insistence on immediate rate cuts, and it's practically diminished market hopes for any cuts within the year. In the absence of White House political pressure and facing inflation data that severely deviates from targets, the market's concern has completely shifted. We're no longer asking, when will they cut? We're asking, will there actually be a rate hike, and when?
In fact, commentator Oh Young-han stated today that if the situation with the Iran war doesn't improve, a rate hike is genuinely expected in June. To put that into perspective, Citi reported that traders have already locked in the next key integer resistance level for the 30-year Treasury yield at 5.5%. With core inflation showing no obvious signs of cooling down and the U.S. economy remaining surprisingly resilient, the Fed cutting rates in the near term is highly unlikely. So what are investors doing? They're reassessing the risk-reward ratio of holding long-term U.S. Treasuries, and they're demanding a higher term premium return. Basically, they want to be paid more to take on that duration risk.
Now, the new chair, WSC, is going to host his very first interest rate meeting in mid-June. The market previously expected him to come in and bring faster rate cuts, but because of the massive divergence between current long-end rates and inflation expectations, that path to rate cuts is nowhere near as smooth as anticipated. Think about it. If dovish signals are hastily released right now, it won't just fail to soothe the bond market, it'll likely be viewed as caving to political demands. That would severely damage the Fed's independence and their policy credibility. And if that happens, the bond market could demand an even higher inflation risk premium, driving long-end Treasury yields up even further. So even before he officially takes office, the market is basically conducting a massive stress test on his policy independence. This current surge in yields isn't just driven by one single event. It's a violent correction to the excessive optimism surrounding risk assets that we've seen recently.
All right, let's pivot away from bonds for a second and look at crypto. Bitcoin prices are continuing to slide, actually falling below that key $80,000 mark. Previously, we saw strong market risk appetite combined with the passage of the Clarity Bill and this joint push of leverage and short covering really driving Bitcoin prices higher. But here's the reality check. Actual spot demand just isn't strong right now. A lot of those cryptocurrency analysts who are super vocal, calling for a restart of the Bitcoin bull market, they're completely silent now. And beyond the pressure from rising Treasury yields, there's another major factor at play here. The most steadfast believers in Bitcoin, South Korean retail investors, are actively pulling back.
Currently, the volatility in the South Korean stock market is actually more intense than in crypto. AI-themed stocks over there like Samsung and SK Hynix are performing exceptionally well. This has sparked a massive outflow of capital straight from the cryptocurrency space into the equity market, essentially leaving Bitcoin neglected. Meanwhile, back in the US equity market, we're seeing a deleveraging process specifically targeting high beta assets. Now, so far we haven't seen any panic-driven, indiscriminate selling. Instead, the profit-taking pressure is heavily concentrated in the technology and semiconductor supply chains. These are the areas that have the steepest prior gains and the most crowded long positioning. Think hardware, chips, optical modules, and storage. Looking at the indices, the QQQ broke below its 10-day moving average right at the open today, and it closed with a solid bearish candle. That unilateral upward momentum we saw for the bulls, it has clearly been broken. Rising Treasury yields are putting serious pressure on tech valuations, even though corporate earnings are still providing a bit of a floor for the index. In the short term, AI hardware is going through some valuation digestion, but the medium-term bullish structure does remain intact. You're going to want to watch the 700 integer mark. That's our short-term support. If we lose that, it's going to further test the support at the 20-day moving average. And if that 20-day average breaks, that would significantly intensify CTA selling pressure from automated algorithms. Synchronously, the S&P 500 also broke its 10-day moving average today, though we did see some buying support step in during the decline. Ultimately, two key variables are going to dictate if this rally continues this week: Wednesday's post-market earnings and whether that military conflict escalates in the Middle East over the weekend.
Now take a look at this chart. It illustrates the historical trend of the S&P 500's 12-month implied correlation, stretching from 2016 all the way to mid-2026. If you're not familiar, this metric basically measures the market's expectation of how closely the index constituent stocks will move together over the next 12 months. Usually, a high correlation sits in the 50% to 65% range. The absolute peak you see on this chart is 67%, and that corresponds exactly to the 2020 liquidity crisis, when the U.S. market saw indiscriminate, broad-based plunging and back-to-back circuit breakers. Everything just moved down together.
But look at where we are currently. The metric sits at an extreme low of approximately 23%. This is a huge deal because it indicates the U.S. market is in a state of extreme concentration and divergence. It perfectly explains why broader index volatility hasn't looked completely out of control. Capital is highly concentrated in just a few mega-cap tech and AI supply chain stocks that are pushing upward, while a massive number of other constituent stocks are just slowly declining. These offsetting movements completely depress the overall correlation. Historically, whenever correlation enters this extreme zone below 25%, like we saw in late 2017, late 2019, and late 2024, it's a massive flashing signal that structural thematic speculation has reached an extremely crowded phase. Bottom line, such a low correlation is totally unsustainable.
So when you combine that with the persistent pressure from U.S. Treasury yields and the stalemate in the Middle East, if the market undergoes valuation deleveraging, this correlation indicator is going to rebound sharply from the bottom. What does that actually mean for us? It implies the market could shift from the current sector rotation and individual stock divergence right into a broad-based decline or a systemic repricing. Simply put, the index is going to experience either a severe drop or a rapid surge in the coming days or weeks. The entire market is going to move together rather than diverging. All it requires is one explosive positive or negative catalyst to trigger it.
Currently, the Volatility Index, or the VIX, hasn't actually priced in this risk yet. It's still hovering below 20. But today happens to be the settlement day for the May VIX contract. When market makers reconstruct their new hedging positions, they systematically reduce their exposure to high beta momentum stocks in the spot market, so your tech and semiconductors. This hedging withdrawal is exactly what caused the sustained drop in momentum stocks this morning, and we only saw it start to recover post-noon as risk pricing naturally self-corrected.
Now, the market's trading focus has fully shifted over to the June main contract, and the latest quotes show that June VIX futures are in clear contango, stabilizing right near 20.38. If you're wondering, contango just means that the forward contracts are more expensive than the near-term ones. It's a clear signal that the cost of medium-term downside protection is rising. The market is absolutely pricing in that mid-June Federal Reserve rate meeting hosted by WS. And interestingly, after today's settlement, capital didn't choose to reshort volatility to bet on a VIX decline. Instead, they bought the VIX directly. This implies that the overall volatility baseline for the U.S. market over this next month is going to be systematically raised. And remember, the risk here is strictly two-sided. We're capable of plunging or surging, so tactical caution is absolutely necessary regardless of your directional bias.
All right, moving from the macro view into some individual stocks, Google is currently consolidating at high levels. They actually held their annual developer conference today, and they released some dense AI updates, really integrating generative capabilities across all their core product lines, from the Gemini search engine right over to YouTube. However, the stock's reaction was surprisingly muted. Also making waves, the Wall Street Journal reported that Google and Blackstone are planning to jointly establish a massive new AI computing company. Blackstone is going to step in to provide the equity capital for a controlling stake, and after joint leverage financing, we're looking at a total scale that could reach up to $25 billion. Google, on their end, will provide the dedicated TPU chips, the software, and the services with a very ambitious target of delivering 500 megawatts of compute power by 2027.
But not everyone is cheering this move. Bernstein warned investors today that this joint venture is going to put intense pressure on third-party cloud services that rely solely on renting chip compute, companies like CoreWeave. It is going to severely suppress the pricing power and the profit margins of these emerging computing service providers. Consequently, related tickers like Ibisico, Viv, and CIV just fell across the board today. CIV actually dropped over 8% intraday before finally paring some of those losses. Since hitting a peak in May, this stock has corrected by approximately 30%, which might actually present a potential structured entry point. Similarly, Intel dropping under $50 presents some really interesting accumulation opportunities in tranches.
And speaking of chips, NVIDIA's stock has retreated a bit from its highs, but the technical structure is still maintaining a very bullish moving average alignment. Plus, the RSI indicator doesn't show any signs of overheating. We saw left-side buying support emerge near $218, while it's facing selling pressure up above $230. Right now, it's sitting in a very typical pre-earnings consolidation phase. But make no mistake, as the global AI leader, NVIDIA's earnings completely transcend the individual company level. They essentially act as the systemic risk marker for the entire US AI market. Literally, the entire market is waiting on their earnings report and future guidance right now. If the report triggers a pullback, watch that 20-day moving average. That's going to be your first line of defense. On the flip side, if the stock surges, it definitely has the potential to break its previous highs and kick off a brand new wave of right-side expansion. Historically, NVIDIA has consistently beaten even the most optimistic expectations on both earnings and guidance, yet its stock price reaction often completely decouples from the actual fundamental data. The post-earnings direction is heavily dictated by institutional positioning, which makes speculative bets right now pretty ill-advised.
Looking at the software sector, the ETF IGV fell back today after an initial gap up, hitting overhead gap resistance as some short-term profit-taking materialized. But pre-market, Bank of America had some huge praise for SVIC, reinstating their coverage with a buy rating and a $130 price target. They strongly believe the company is an absolute beneficiary of AI monetization rather than a victim. The projections are stellar, estimating the company's 2028 revenue growth will sustain somewhere between 18% and 20%, with free cash flow margins reaching a whopping 35% to 37%. Driven by this news, the stock surged over 7% at the open before retreating a bit.
We saw SAP exhibit some really similar intraday price action, opening high and then moving lower. The company just announced that it's jointly developing generative AI infrastructure alongside NVIDIA. They're deeply embedding it right into their business software platform, alongside some major collaborative engineering projects. Amid all this broad pressure on traditional application software, SAP is aiming to leverage this deep integration with NVIDIA and AI agent deployments to really revitalize institutional interest.
Ultimately, our primary catalyst looking ahead remain tomorrow's post-market NVIDIA earnings and those ongoing weekend geopolitical risks in the Middle East. It is entirely logical for capital to exhibit cautious sideline behavior right now, given the highly binary, high-stakes nature of these upcoming events. So here's the big question to leave you with. With these binary geopolitical and earnings risks looming over us, how exactly will the market resolve this extreme concentration and the lowest implied correlation we've seen since 2020? Think about that. Thank you for joining this explainer, and we will catch you in the next one.